Folks, Charlie Gibble, certified financial planner here. Hey, I want to talk about a couple of concepts: tax deductions versus tax credits, as well as above the line versus below the line. This was prompted by a conversation I had with a nice gentleman here in the workout facility, and we were talking about this new $6,000 or $12,000 for married filing jointly. This new tax deduction for folks that are 65 years of age or older, that's effective 2025 tax year through the 2028 tax year. I'd made the statement to him that he says, what if I itemize my deduction, or what if I take the standard deduction, I don't itemize my deductions? And I'll explain what this means. So it's available either way. This deduction is available whether you itemize or whether you take the standard deduction. He goes, oh, okay, so it's an above the line deduction. It's above the line, right? I said, no, technically it's not. It's not above the line because it does not reduce your adjusted gross income. He says, well, that's weird. So I thought I would explain here a quick concept. What are above the line deductions? You see, here is how your tax return works. At the top, you have all of your income coming in: wages, W-2 income, tip income, maybe income from a business like my business, right? So it's the income, then you have the adjustments to the income, such as maybe I contributed to a traditional IRA and that can offset that income up there. And then you have adjusted gross income, which is, well, this up here subtracted from my total income, right? Well, once we have our adjusted gross income number, you hit a fork in the road on that tax return. And that fork in the road is this: do you itemize your deductions, or do you take the standard deduction that our government gives us, the standard give me, so to speak? Most people take the standard deduction because it's so high. It's $31,500 now for those less than 65 years of age. Those older than 65, it's more. So most people take the standard deduction. And then after that, it is, okay, so here is your taxable income. Multiply that times your tax rate, and that is the total tax due. That's the way that your tax return works. Well, an above the line deduction happens up here, how I started the conversation, right? So whether you itemize or whether you take the standard deduction, an above the line deduction is a good thing, meaning either way that you take on that fork in the road, itemization or standard deduction, you get to participate in a tax reduction if it's above the line. If it's below the line, that is generally just if you choose the itemized deduction route. So an above the line deduction, you get to participate in generally. Below the line deduction usually is only given to you if you itemize your deductions. Now this new $6,000 or $12,000 deduction, that is technically a below the line deduction because it does not reduce your adjusted gross income. However, whether you choose itemized deductions or standard deduction, it will be available to you. So it's a little bit of a fluke in that way, and that's why this guy said, oh, so it's an above the line deduction. Well, technically not, because it will not reduce the adjusted gross income. And folks, a good financial planner will try to help you reduce your adjusted gross income, because that is probably the most important number on your tax return, other than the total tax due at the very bottom. All right, so that's above the line versus below the line. Secondly, tax credits versus tax deductions. Tax credits are generally better than tax deductions. A deduction from your income is only a portion as powerful as a dollar for dollar credit against your total tax bill, right? So when we talk about tax credits, $1,000 tax credit, that means your total tax bill is reduced at the end, at the bottom of that form, dollar for dollar by $1,000. If you have $1,000 tax deduction, that may only be 50% to 80% as powerful because it's up here before it gets diluted down with all these calculations. A tax deduction may only be 50 to 80% as powerful as a tax credit. So there's a few concepts for you.